In this video, we're going to start talking about disposals. We've had this Toshiba laptop now. We've depreciated it for $750. Now we're going to dispose of it. Before we start talking about disposals, let me remind you of something I know I've explained many times before. In our standard little set of financial statements here, we are showing what could be considered three funds. You heard me right. Let me see if I can explain what I mean. We have the operating fund, which would be one, and then in the plant fund we have two sub-funds. One sub-fund holds all the money right here that has been designated for our future fixed asset purchases. So in the example, the accounting manual, there's $1,245,890 of assets there, and that sub-fund owes the $2,000, leaving a fund balance for that sub-fund called the unexpended plant fund of $1,243,890. So we have the asset minus the liability, leaving us the net assets of that sub-fund of $1,243,890. The other fund is called our invested in plant fund, and it has the assets minus the mortgage on the assets, leaving us the $3,975,856 in the net assets of the invested in plant sub-fund. Don't worry, I didn't make all this up. I just teach it. So the plant fund consists of two separate self-balancing sets of accounts. One self-balancing set of accounts is called the unexpended plant fund. The other self-balancing set of accounts is the invested in plant fund. In most practical cases, we don't have mortgages, so in most of the SunPlus world, this figure right here of land, building, and equipment is supposed to equal the invested in plant function. Then the unexpended plant function, which most people don't have, everything else belongs to the unexpended plant function. I know you've heard that explained many times, but right now let's realize what's going on as far as disposals. The assets to buy the laptop came out of the operating fund. Whenever it came out of the operating fund, it just was a direct reduction of the net assets there. As far as the operating fund was concerned, it was a reduction of the net assets, just like an expense is a reduction of the net assets. It's gone. If we had bought it out of the unexpended sub-fund, it would have also come out of the net assets, just like an expense comes out of the net assets. And as far as the unexpended plant function is concerned, it is gone. And then it automatically appears over here in the invested in plant function. And it's there, just like it's a revenue from the perspective of the invested in plant function. It's an increase in the net assets of that invested in plant function. Once you start thinking about these things as separate, then it starts making sense on how we're going to record the disposal of the fixed assets. Let's go over to my blackboard here and see if we can't make any sense out of this thing here. We have our Toshiba laptop that cost us $2,500. Accumulated depreciation on it was $750, and so that leaves a remaining book value of $1,750. Now let's sell this laptop for $2,000, just so we have a class example. If we had sold this for $2,000, all of us can remember sitting in good old Mrs. Harris's bookkeeping class, we debited cash for the $2,000. We at least got that part right. We know we'd get that right on a test. And then we would know that we no longer have the asset, and so we would need to debit accumulated depreciation to remove that. We don't have the accumulated depreciation anymore. We've sold the asset, so it was a credit balance in that account, and we need to debit it to get rid of it. And we need to get rid of the cost, and so that would be the equipment account. And the equipment account was debited when we bought it, and so we're credited to get rid of it. I'm sure you're all very familiar with this. And then we would need to balance. And so we have a book value of $1,750 and we sold it for $2,000. So that meant that we had a gain on the sale for $250. It makes lots of sense to do it this way in our class examples back when we were in college. And this is the way it would be done in a business. However, when we bought the asset in our business, the accounting ledger that bought it retained it and now is selling it and getting the money after it's been sold. So it would be logical to record it this way. But in a nonprofit entity, when we bought it with our fund accounting, the operating fund bought it and completely wrote off, so to speak. It completely absorbed this cost as a reduction of its net assets. So if it were to get $2,000 back, it should be able to put all of the $2,000 back into its net assets. I know this is a little bit confusing. Let me try explaining it twice. When a regular business buys it, its net assets of the business, the capital of the business, did not go down any when it bought the asset. So when it sold it, only the gain increased its net asset. But in our fund accounting, when we bought it, the purchase price was complete reduction in our net assets. So when we sell it, we're going to put all of the net assets back in there, and so it's a complete increase. So if we were doing this exact same example in church accounting, we really have what could amount to a two-part entry. We're going to debit cash, and we have to pause there for a minute and think about, where are we going to debit the cash? We're going to debit the cash wherever the money went. Okay, so if we sold it for $2,000 and the board says take the $2,000 and save it for buying future laptops, then we will put it in the unexpended portion of the plan fund. But there could be no place that we put it, just goes back into the operating fund, and so it could be a debit into the operating fund. So the $2,000 is going to be debited into whatever fund and whatever function got the $2,000. So what we're going to do is debit cash and credit proceeds from sale of disposal of fixed assets, and that is a revenue account, and that can be in either the operating fund or it can be in the unexpended plan fund. Either one of them gave up their all when they bought it, so whenever they sell it, they get it all back into the net assets. So the whole purchase price came out of their net assets, so it makes sense that if we sell it, the whole proceeds go back into their net assets. I hope that's clear. So this entry right here, debiting cash and credit proceeds from sale, records the cash that we got into wherever got the cash. So if it was the operating fund, this entry would be made in the operating fund. If it were the unexpended plan fund, it would be made in the unexpended portion of the plan fund. One of the two have to get it. And if it goes back into non-tithe, because it was a non-tithe asset when it was bought, it would be okay to code it to non-tithe. Or if it were tithe when the asset was bought, we'll put it back into tithe. And so the function on this would be wherever we're putting the proceeds back. So we have that. And then in the invested in plant portion of the plant fund, we need to get rid of the asset. So we'll debit accumulated depreciation for $750, and we'll credit equipment for $2,500, and all the book value goes into asset disposed account, okay, the asset disposal account, and that is the whole amount comes out of the net assets of the invested in plant. The invested in plant fund has no value left for this asset in its net assets, so we need to remove the whole thing. So I hope that makes a little bit of sense. So our automatic process to record the disposal in our asset register is doing just this last entry. It's going to clear out the equipment account, it's going to clear out the accumulated depreciation account, and it is going to stuff the entire book value into whatever account we designate. And so let's go and look at that process. We're ready to record the disposal in the asset register. Let's look at our asset that we want to dispose. And so we have FA04. This is that Toshiba laptop, and you can see here right now we've got $2,500 in the cost value and $750 for the the accumulated depreciation. We're now going to dispose the asset. We'll go to amend, and then we'll come right here, ready for disposal. I won't have another chance to talk about here, but I can suspend this asset so depreciation isn't recorded on it anymore if I want to mark it as a held or suspended asset, but I want to dispose of it, so I will click that right here, ready for disposal. And I can do this for several assets at one time. I could go to many assets and mark them for disposal this way, and the process that we're going to go through disposes all of them in one fell swoop. But we're going to do it nice and slow and just do this one asset. It is ready for disposal. I go OK, and we'll exit, and then we go to asset disposal. This is not choosing the ones for disposal. It's a little bit confusing. This is choosing the range to look for the ones that have been marked for disposal. So I can put A to ZZZ, and I don't think I have any others marked, so we should pick up just that one, and I want to dispose of it, and the 6th disposal period 2014, and this account right here is going to be the account asset disposal that I talked to you about just a second ago over on the whiteboard. It's the account that is getting the book value. We want to post the transactions, yes. Remove asset details. Now 99.999% of the time you want to say no, do not remove the asset details. There has been occasions when I have had to remove asset details. I've accidentally created an asset and I wanted to completely eliminate any trace of me having set it up because I set it up wrong. This is suspense account if the entry doesn't balance, and so we just put the same number down, and so we're good to go. And we've created a journal entry here recording this disposal. This is not the journal entry, by the way. This is the disposal listing. It's going to sound repetitive because the journal entry is going to give us the exact same information, and you could see where it has removed the equipment, crediting the furnishing and equipment account, debiting the depreciation, and instead of taking the net amount and putting it to this account 97710, it puts this and that, so you can sort of see the logic. Let me bring up the JV, and it's essentially the same as what we just looked at. Crediting the equipment account, debiting the accumulated depreciation account, and then crediting and debiting the disposal account for what nets to the book value. And so the net effect of these two would balance that. The asset is removed, the accumulation depreciation removed, and the book value is put into account 977110. And so that is the disposal of the asset, and it is gone in exactly where it's supposed to be. The net asset was complete reduction out of the investment in plant fund, and the money is a complete addition over to wherever we put the money, because essentially the opposite of that is happening whenever we buy it. I know it's just a little bit confusing. It's primarily confusing because of my ability to explain it, but I think that if you think about it a little bit, you'll make some sense out of it. So thank you for watching this video.